And this is chapter 10. I will share the screen again. And we will be talking about financial management and accounting in the global firm. So this is an overview. I am sure you will get much more detailed information in accounting classes and finance classes. So the international financial management area. Once you enter into this world of exchange rates and having subsidiaries and paying taxes in one country and another country and whose laws apply where, you are in a very complex environment. And the acquisition and use of funds for cross-border trade, investment, and commercial activities is something that has grown tremendously and is very valuable to world economies. The multinational enterprises must carry out transactions in a multitude of foreign currencies in very different environments and with a lot of different regulations. They're also looking at restrictions on capital flows, exposing themselves to risks in different countries, and they're facing a variety of accounting laws and reporting, how the accounting is reported, and tax systems. So firms access funds through a variety of sources. So they have foreign bond markets, the stock exchange, banks, venture capital firms, intra-corporate financing, and they're looking for where is the cheapest capital that they can access. So for example, Motorola. Motorola has facilities in nearly 50 countries, and they raise funds in financial markets worldwide. So their managers are familiar with the laws and regulations that govern these exchange rates worldwide. And the financial dimensions of Motorola's activities are managed globally through a strategic network worldwide, not just through the headquarters. It is complex, but we set things up to reduce risks, to optimize their capital investments and structures, and to mobilize their finances globally. So what are the tasks? International financial management has a number of tasks. So first, to choose a capital structure, determining the ideal long-term mix of debt versus equity that they will have. Number two, raise funds for the firm. So acquire equity and debt or intra-corporate financing. Number three, working capital and cash flow management. So manage funds passing in and out of the firm's activities, and hopefully that company is adding value through the process. Number four, capital budgeting. So assess financial attractiveness of major investment projects. Number five, manage currency risks. And number six, manage the diversity of international accounting and tax practices. So we're going to go through each one of these. Task one, choosing your capital structure. The capital structure is that mix of long-term equity and debt. And a firm obtains equity by selling stock to investors or by retaining earnings and not paying it all out to the investors. And they can sell stock, or which is equity in the firm. In new firms, founders may provide equity from their own personal savings. So then debt financing comes from either loans from banks or other financial intermediaries, or money raised by selling corporate bonds. Task two is raising funds. So a firm may go to the global money market, the financial markets where the firms and governments raise short-term financing, and they may look for those willing to invest money in their company. They could go to global capital markets, and the financial markets where firms and governments raise intermediary and long-term financing. And by participating in the global market, capital market, firms can access funds from a larger pool of capital at very competitive interest rates. So our financial centers, the major centers are New York, London, and Tokyo. And then secondary centers are Frankfurt, Hong Kong, Paris, San Francisco, Sydney, Singapore, and Zurich. So firms will look for major capital suppliers such as banks, stock exchange, venture capitalists at these centers. In 2011, international issues of equity in world securities markets were about 500 billion, up from 83 billion in 1996, which is really explosive growth worldwide, right? These are shares of financial markets in world regions in percentage. So market capitalization, stock exchanges, international bonds and notes, foreign exchange turnover, cross-border bank lending, and bank deposits. So what are some of the causes of this rapid rise in global capital markets? Government deregulation was one that facilitated move of funds across borders, innovation of information communication technologies, globalization pressured the firms to seek new and lower ways to finance their operations, and the widespread securitization led to conversion of illiquid financial instruments like bank loans into tradable securities such as bonds. So the advantages of the global capital markets for a firm are that compared to being restricted to financial markets in one country, you have a broader base. There's greater breadth of financing sources. So you can access money at a lower cost, and then it provides a variety of investment opportunities for professional investment firms, individuals, along with the multinational funding. So sources of funding, you've got equity financing, so selling stocks, and exchanging the global equity market. We'll skip this. Debt financing, so you could sacrifice a bit of your ownership and take on another investor. You can borrow money from a creditor in exchange for repayment or of principal and interest. There's debt financing from loans from banks or sales of bonds. So internationally, quite complicated. The world's primary banking centers are the US, UK, China, Japan, France, and Germany. And this is in billions, how much money is invested in those areas. China has an emergent banking center and rapidly becoming the world's largest economy and central of global banking. We don't know what all of this is going to look like yet, but we can see great strides being made as the Chinese government and corporations start to invest internationally and positioning Shanghai as a global financial hub. The euro currency market, it represents money deposited into banks outside its country of origin. And the euro dollars are US dollars held in banks outside of the United States. So foreign bonds are sold to the bond issuer's country. So when Mexico's CEMEX sells dollar-denominated bonds in the US, it is issuing foreign bonds. Euro bonds are sold outside the bond issuer's home country, and it denotes that it's not its own currency. So it does not mean that this is from Europe or the euros. It's a term used for any exchange outside of your home country. Source of funding number 3 is intra-corporate financing. So obtaining funds from within the firm's networks of subsidiaries and affiliates. And we have a lot of this going on where we form a partnership in another country and we create a subsidiary and affiliate over there, and they help fund the operation in that local economy for a price, of course. So, task 3, working capital and cash flow management. Cash flow needs arise from everyday business activities. So we need to pay for supplies, we need to pay our employees, we need to pay taxes, etc., right? So cash flow becomes very important. And cash flow is complicated going across national borders. So how do we optimize it? You have the parent firm, and they have a Taiwanese subsidiary and a Mexican subsidiary. So they've invested and provided fronting loans to Mexico. They have equity capital in Taiwan, but Taiwanese subsidiary has also remitted dividends and paid royalties back to the parent firm. But setting at low transfer prices, we can have exchanges between our subsidiaries as well, and they can provide loans to each other, extend credit on purchases to each other, and that helps out the parent company as well. So how do we transfer funds within the multinational enterprise? We have trade credits, we have dividend remittance, and we have royalty payments. So in a three-way transaction, maybe I've lent $10 to person A, and let's see, person B owes me money. Instead of paying money to me, they pay it over here and it comes back. So in the end, all the money is flowing, and technically the more it flows inside one economy, the healthier that inside one firm, the healthier that firm will be. And it can actually even avoid the high transfer rates to some countries by transferring between the subsidiaries. Okay, so another way is a fronting loan. So the parent deposits a large sum in a foreign bank, which then transfers the funds to the subsidiary in the form of a loan. And that fronting allows the parent to circumvent restrictions that foreign governments impose on direct intracorporate loans. We have transfer pricing, or intracorporate pricing, the price that subsidiaries and affiliates charge one another as they transact business between each other. And the firm can use transfer pricing to shift profits out of a high tax country into a low tax country. The multinational enterprises also pool supply funds into a central depository, and that functions either globally or for a region, and then the funds are then directed to needful subsidiaries or invested to generate income. We have multilateral netting, strategic reductions of cash transfers within the multinational enterprise family through elimination or offsetting cash flows. Task 4, capital budgeting. So managers use capital budgeting to decide which international projects are economically desirable. They look at net present value of a project, looking at the initial investment, the cost of capital, the amount of incremental cash flow that will take place over time. Task 5, currency risk management. So all these exchange fluctuations provide a risk to a company that could harm their profits, right? So they have transaction exposure. the currency risk that firms face when outstanding accounts receivable or payables are denominated in foreign currencies. If those foreign currencies are not stable, the company is at risk. Translation exposure, when we translate financial statements into a functional currency of the parent firm, and then economic exposure is that currency risk from exchange fluctuations. So foreign exchange trading. So a relatively limited number of currencies facilitate cross-border trade and investment, and it's usually dollars, euros, yens, or British pounds. The daily volume of global trading is more than $4 trillion. This is daily, which is more than 100 times the daily value of the global trade of products and services. Large banks are the primary dealers in currency, and yes, more and more of this is being done online. So types of currency traders, we have hedgers. They seek to minimize the risk of exchange rates, so they buy forward. So they speculate on what the exchange rate will be on such and such a date, and they sell at that price. Arbitrageurs are currency traders who buy and sell the same currency in 2 or more foreign exchange markets, and they are profiting from those daily exchange rates. Exchange rate forecasting. So we do try to forecast what that is, what the exchange rate is going to be, and conduct business in those forecasted areas, and hopefully it plays to our favor. So hedging refers to the efforts to compensate for possible loss from a bet or investment by making offsetting bets or investments. There are a lot of regulations around hedging, and it's a very regulated environment. Task 6, manage international accounting and tax practices. So one of the biggest challenges is that our accounting reporting systems from one country to another have different standards, and we have we've standardized some, and we have regional standardizations, but there is still a need to do more. So how we go about setting up financial statements, and what we report, and what is tax deductible and what is taxable, and everything is of concern for the parent company, because they want to take advantage of the lowest expenses, right, and deductions in every situation, and then still have a standardized way of reporting. So this is 9 steps to, or guidelines for minimizing currency risk. So you seek expert advice. You centralize currency management within the multinational enterprise. Decide on the level of risk the firm can tolerate. Devise a system to measure those exchange rate movements and currency rate. Monitor changes in key currencies. Be wary of unstable currencies. Monitor long-term economic regulatory trends. Distinguish economic exposure from transaction and translation exposures, and then emphasize flexibility in international operations. So transparency in financial reporting is of great concern for the home, for the government in the home government, I guess is what I'm trying to say. So wherever your multinational is headquartered, that country wants to have control over transactions and transparency. And the more transparent we are in our accounting systems, then our finances actually are more reliable, and the trust in that company is increased. So we do have an organization, International Accounting Standards Board, and they are working to harmonize world accounting systems. This is being used quite a bit in Europe. The US has not adopted it yet, but the system that we use is getting closer and closer to the IASB. Some other final concerns: tax havens. Some countries are hospitable to business and inward investment because of their low corporate income taxes. So Bahamas, Luxembourg, Monaco, Singapore, Switzerland are some of those examples. And multinational enterprises have an incentive to structure their global activities to minimize taxes and take advantage of these tax havens. And here are some corporate tax rates for different countries. Argentina is at about 35%. The United States looks like it's the highest, except for Japan. Japan surpasses the tax rate of the United States. Thank you very much, and I look forward to seeing you guys next week.